Welcome to Maine's October virtual. My name is BJ Bellock. I am one of the founding members here at Maine, and it's my pleasure to open this call and look forward to a very robust discussion. I will introduce Ritu Khanna of Thunder Capital, and she's going to take over from here. Ritu?
Thank you, BJ. So yes, as BJ mentioned, my name is Ritu Khanna, and I'm the Director of Investor Relations at Thunder. We're an advisory firm focused on founder-led companies. These can be anywhere from early stage to growth, and we also work on M&A transactions. And we are sector agnostic, which means one day I'm focused on sports tech, and another day I might be focused on healthcare, which makes it pretty interesting. And of course, this includes companies in the digital asset space, which is why I'm excited to be here to discuss the latest trends with one of the leaders in the space. And so, Sandeep Kaur, it is my pleasure to introduce her to you. She has been working in the digital asset space for over 11 years. She's previously advised banks, asset managers, and startups on tokenization, stablecoins, and blockchain adoption through senior roles at Innova Solutions and Wheels and Company. And then later she was at Circle, where she played a pivotal role in launching USD Coin, which is now one of the world's most widely adopted stablecoins. So pretty impressive. And she also launched a decentralized exchange while there. Today, she is the founding partner of Sebal Capital, a digital asset investment firm focused on delivering structured strategies that balance both downside protection with long-term growth. So, Sandeep, is there anything you'd want to add to that?
Thanks, Ritu. I think you covered pretty much everything, but I definitely want to talk about my fund and why I'm launching it. So just before, launching my fund, I was at Innova Solution doing consulting, and looking at the space, especially when last year ETFs got approved, we kind of seeing a lot of money that's coming into this sector. And one of the, many people, they have this misconception, and volatility is not for everyone. So that's why we came up with these downside protection strategies where we manage the volatility and provide, basically, help investors. So that's kind of, a little bit about my fund. Yeah.
Fantastic. So, for today's discussion, I thought it would be best to keep it simple and cover five main themes that we're seeing today that are of particular importance to the digital asset world. So those would be macro drivers, regulation, AI, of course, investing across generations, and then what we see going forward. So let's dive in. Sandeep, when you look at like different macroeconomic forces, what are you most concerned about in the current cycle? So, in other words, we might look at metrics in the news such as interest rates, liquidity, global monetary policy. How do all of these impact the digital asset world, and what should I be paying most attention to?
What Ritu, we have noticed, Bitcoin cycle especially, it trades parallel to NASDAQ, and liquidity drives it. That's what our research shows. Many people, they have this misconception, Bitcoin trades, purely on sentiment, and actually that's not really true. So, that's why I brought up this chart of ISM and Bitcoin comparison. And if you look at this chart, we can clearly see that every time when ISM, so this ISM index, first thing, it actually monitors business, it tracks business cycle as well as basically business activity and liquidity. When it turns high, Bitcoin leads the next upcycle. And it's not reacting to inflation or headlines, it's responding to the liquidity. Every time when ISM is above 50, we kind of see that from there, Bitcoin cycle kind of starts going up. So another thing that we can talk about is just yesterday, Fed, their decision came up and they cut rates by 25 basis points to 4%. And so now it's like on to 4%. And also they made an announcement about ending quantitative tightening, right? That's starting December 1st. So this is like a clear signal. We kind of now would be transitioning from restrictive to accommodative policy. So in our world, that means the probability is high. We will see more liquidity in the future, kind of, coming up into the market. And so basically, based on our analysis, we kind of see that cryptocurrencies, as well as, especially, I'm going to here talk about Bitcoin, because Bitcoin correlation is very, very, if you can, Britt, move to the next slide. Yeah, so here we kind of clearly kind of see that Bitcoin and NASDAQ are literally trading tick to tick. And that's again, if we talk about like interest rates and market correlation, like how that is correlating. So interest rates are more like an on and off switch for global liquidity. When rates rise, liquidity kind of drains and risk assets derate. When they pause or start falling, liquidity comes back, and Bitcoin sitting further out of the risk curve, but we see there like response first and fastest. So both, basically, as we see that NASDAQ and Bitcoin are trading like tick to tick, so both are liquidity proxies. The only difference is that Bitcoin amplifies that move. So it's more like NASDAQ on leverage, same macro drivers, higher beta. So that's another trend that we are noticing in this cycle. Britt, also, if you can move to the third slide, because that's like the overall chart. So here we can see like Bitcoin correlation with macro factors. And especially here, so we kind of like analyzing it from looking from like since 2013. So if we see it here, the data backs that up. Over the past five years, Bitcoin correlation to global M2, which is global money supply, it is roughly plus 0.7, and to the Fed fund rates about minus 0.7. So when central banks ease policy or liquidity expands, we kind of consistently seeing that like Bitcoin consistently rallies from there. So what is different than in this cycle? So what's interesting about this cycle is how orderly it's been. Both equities and crypto are trading near all-time high right now. If we look at the volatility index, VIX, that's between 14 to 17, so which is more like it's been normalized, right? Not collapsed. So the VIX sits at the lower end, mostly end of its range, and Bitcoin realized volatility also has compressed significantly since March. We are not seeing very volatile market the way it used to be before. So even the price is above around like 110K. So that tells us, isn't it like it's not only retail Europhia anymore, it's institutional positioning. And this year, we are like literally seeing a lot of money, mostly into ETFs and digital asset treasury companies. So we kind of seeing liquidity confident, not like speculative access. So kind of like sums up this up all. We can say that crypto doesn't trade on hype. It trades on liquidity. That's the data point that we kind of follow. We always follow, liquidity data point. And with now Fed cutting interest rates and ending quantitative tightening, the macro tide are also clearly shifting. Another thing, because right now we're kind of seeing a lot of noise in the market around tariff. So that definitely, when that comes in, we kind of seeing a lot of moves in the market. But overall, we're moving from a liquidity drain to liquidity expansion phase. Another data point that I just kind of also watching, we have almost $7 trillion sitting at money market funds right now. So now interest rates are going down. The probability is again there, some of them, they look for more returns and, yield. So some of that money may start coming into other assets. So historically, that's exactly, basically when there's like liquidity expansion, that's when Bitcoin is leading. And this time institutions are leading with it. So far, we are not seeing retail money into this market. Yeah.
Sandeep, I have a question for you that we've spoken about previously and that folks may find interesting. Um, a lot of the law firms that I've spoken with had an interesting reaction when I told them that you are accepting cryptocurrency into the fund from investors. Can you explain why you're doing that and how that impacts your trading strategy? Because of course, if you're taking crypto,
Mhm.
there's some considerations around that as well.
Yeah, so on regulation perspective, we must be complied to the current regulations, right? When we are accepting cryptocurrencies from investors, so that's what we kind of working with, law firms, and we would have to register with CFTC, NFA, all of that. So that work is already in progress. So that's more like we as a fund make sure we comply to all the regulations out there. So that's the one thing, accepting cryptocurrencies versus fiat. Yes, actually accepting fiat is very easy because that's a fixed amount. And right, you can say that, okay, this is the fixed amount and you have in your fund. And yeah, but when you're accepting cryptocurrencies, then because of the volatility, there's a market price. So that's, so we're working with our fund admin. And on that side, actually, so at the time when we accept that money, whatever, if someone is sending us two Bitcoin, 5 Bitcoin, 10 Bitcoin, so that's what it is, right? Like whatever the value is, that's, of course, there's a market value for that, but end of the day, the real investment is like 10 Bitcoins or 5 Bitcoins, whatever that is, or if someone is sending Ethereum, whatever the quantity of Ethereum, because end of the day, 1 Bitcoin is equivalent to 1 Bitcoin only. So that's simple math. And what was your second question, BJ? Sorry, I didn't take my note.
Well, of course, that's going to factor into how you align your portfolio relative to the volatility around the incoming funds from the crypto. So, what kind of
So
considerations
on
are
the
there?
Yeah, so on the strategy side, it doesn't change anything. We are right now trading two very simple strategies. So our downside protection strategy, where if the investors are very, very conservative, and so then the max they kind of lose, they can lose is let's say 10%, but then the upside is also 35%. So that's on the downside protection and being very, very conservative. But on the other side, where you can, on the other strategy, basically, so that is, earning yield as well as the upside. So on that, we are mainly trading these three tokens: BTC, Ethereum, and Solana. Only these three blue chip, because that's where we kind of see a lot of liquidity. And some of the XRP also. In one strategy, actually, in the downside protection strategies, we are trading XRP too, but not on the yield and upside potential strategies. So for that, we only have these three main coins: Bitcoin, Ethereum, and Solana. Given most of the liquidity is there. So regardless, you bring fiat currencies or you bring cryptocurrencies, the strategies are the same. The only thing is when investors bring fiat currencies, then we would be converting that into cryptocurrencies because we are trading cryptocurrencies, spot crypto, right? So then we'll be converting into that and then kind of generating revenue from it. Yeah.
Okay, thank you for that. And the next topic I'd like to discuss is regulation. So this summer, we saw the passing of the Genius Act, that stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act. And that really establishes the regulatory framework for payment stablecoins and right now that we see the Clarity Act that's advancing through Congress. So how are these regulations going to shape the future of digital assets as an asset class? And why does this regulatory clarity matter for institutional investors?
Thanks for asking this, Ritu, because this is really something very, very important. So far, our industry, this regulation has been one of the biggest hurdle rate for this industry. So if we step back for a moment and we only look at these 2 years, 2024 and 2025, these 2 years have quietly become historic years for digital assets. For the first time, the US isn't debating whether crypto should exist. It's building actually a rule book for it. So between the Genius Act, which became law this year, it was issued on July. It was passed on July 16th, and Clarity Act moving through Congress. We are watching cryptocurrencies evolve from a speculative frontier into a regulated asset class. So that's one. And the second thing is crypto as a new asset class, and for any asset class to mature, especially before institutions allocate meaningful capital, you need regulations first. And until now, that was exactly that we were missing. So this is where we can see. So last year, 2024, when ETFs were approved, so that was basically gave green light to many institutions, right? They could now invest into a regulated asset, and looking at IBIT, BlackRock ETF IBIT, that has been one of the most successful ETF in history. They already have like, I think 100 billion in AUM, like really ridiculous in less than 2 years. So that's one. And with Genius Act, passing, we consider it as more like a Chat GPT moment for cryptocurrencies. And it effectively turned the US dollar into a software. So Genius Act is actually for the stable coin. So today we are literally trading our US dollar, it's turned into a software, and it became globally accessible, programmable form of money through regulated stable coins. So that's really powerful, because what we really see that it democratize access to the dollar. So any countries anywhere in the world, anyone, now, especially if we talk about countries where local currencies are unstable, people can now actually, they have access to the US dollar, and they can hold, send, and even, earn yield in tokenized US dollars directly from an app without any intermediary, or like, paying a conversion fee, whatever that is, 3, 5%, 10%, whatever that fee is. So I think that's a really big win, and it is actually good for the US dollar. And just looking at the data, in the short time, so data speaks for itself. Stable coins are now exceeding more than $300 billion in circulation. And issuers like Tether and Circle are among the top 20 holders of US Treasuries. Brett, if you can bring up that slide, I really want to show like where do we stand. So here, yeah. So these are like top 20 holders of US Treasuries. Actually, this was research it was done by A16Z, and this is even before Genius Act was passed. It was June 30th. So as of today, stable coins are definitely moved little up. I think it's above Norway. It's somewhere around 182 million. A billion, 182 billion, like somewhere there. So which is also a very, very good sign. So for institution, this is basically our turning point. Regulation brings definition, who regulates what's reportable, and what's safe to custody. So combine like this ETF approval and Genius Act, as a law, we are finally given institution green light to build infrastructure, not just trade, exposure. So now with the Clarity Act, if we talk about that, so on the Clarity Act, actually, what Clarity Act does, especially we kind of hearing a lot from BlackRock and, Franklin Templeton, Wisdom Tree, they are the early kind of mover of tokenization of assets. But Robinhood is already kind of way ahead. They're building a lot on tokenization of assets. And last month, actually, NASDAQ also made an announcement. I think it was on September 8th. They filed with SEC, and they would like to tokenize all their equities. So Clarity Act actually, it sets the foundations for tokenization. It defines what's digital commodity versus a security. And that has also been a big confusion so far. What is commodity, what is security? So CFTC, SEC, falls under where. But now CFTC, SEC are also working together. They also have a digital asset division, and they kind of, trying to bring more clear regulations to this industry, which is also a positive thing. So that will provide more legal certainty, especially of course, for big firms like BlackRock, Franklin Templeton. They have their money market fund, and NASDAQ, as they launch their tokenized fund, tokenized treasuries, and on-chain market. So when I look at 2025, I see convergence like regulations, tokenization, institution validation. The US dollar has become a software. That's how we bridge traditional finance with new digital system. So all these are basically moving pieces now.
Sandeep, quick question for you. My background, as you know, is fixed income trading for many years, and I used to run a repo book. Can you enhance the yield based on the fact that treasuries can be repurchased or reverse repurchased based on what's underlying the stable coin?
So, BJ, what are we doing right now? So we have a fiat-based stable coin. So every time when we mint a stable coin, we kind of maintain the collateral of that, right? So $1 equals to one US, stable coin. So stable coin are nothing but representation of US dollar. And that's why, we kind of seeing this, stable coin being like the top 20 holders of US treasuries, right? Because you have to maintain that as a collateral. And another thing, many companies, including Circle and Coinbase, because USDC stablecoin, and I'm talking about this, and of course, there's so many others also. I'm specifically talking about these two because it's more like the known one, right? USDC and Coinbase, of course, publicly traded company. So they all kind of providing yield also to their customer, which is more like a fixed yield on your stablecoin when you hold stablecoin in your wallet. So that's very similar to, you have money sitting in your money market fund and you're earning yield on it. The same way now you are holding stable coins and you're earning yield on your stable coin, and that's in your digital wallet. The thing is, with money market fund, it is always, there is a restriction. You cannot, because it's fixed income, and there's a time frame. It's a you can't touch your money for certain amount of time, right? But with stable coins, there's not anything like that. It has to be there for minimal certain months. So that way it's like more flexibility, and you get yield, you earn yield on your investment or on your stable coin as it's in wallet, and it's calculative. If it's, let's say, for Coinbase right now, I think it's 4.25% APY per year. So that's they just calculate that, and they will just issue you your earning yield weekly. So that's how it's working right now. But then many other firms, they have a very different structure. There are other stable coins too, which are more, which are not like fiat focused or which are not maintaining fiat as a collateral. So then those are the different ones. So then they are maintaining their collateral from that angle, and then the yields are different for them.
Okay. Okay. I did want to, well, actually now I'll ask that later. Let's move on to AI for now. So, we've seen a lot about AI in the past year or two. We've seen a lot about blockchain in the past. How do you see these two technologies working together? Are there any real life examples that we can talk about?
Actually, that's one of my favorite topic, and it's something I'm personally very bullish on. Um, I see AI and blockchain as two technology that are quietly building the future of finance. So let me actually explain it this way. Remember, we used to have those old dial phones. You pick up the phone and you dial a number one by one, and every long distance call used to cost money. And then came the smartphones, and now we can call anyone in the world instantly for free over the internet. If 30 years ago someone would have told you, you know what, in the future you can just pick up your phone and you can do FaceTime anywhere in the world for free, they may have like doubted that, like, really, right? Because just for the dial phone, we were paying a lot of money, right? So this is how we kind of like, see that the shift is happening with money. So the old financial system is like that, we can say the dial phone, which is slow and expensive, and they are full of like middleman. But as finance moves into AI and blockchain, it becomes faster, smarter, and cheaper, just like our phones did. So AI actually brings the intelligence. Um, System that can think, learn, and make decisions. Blockchain brings the trust. It keeps a secure record of what really happened, so nobody can change it later. Together, they make financial system both smart and honest. So, I was kind of like reading this one research, and it was, researchers, they kind of estimating that by 2030, there will be around 10 billion AI agents. So think of them like digital assistants or even robots that can do tasks, make decision, even pay for things themselves. We kind of hearing a lot on humanoid robots, and actually, especially if you go to 2049 token conference in Asia, I mean, it was really it was even for a minute, it was kind of a little creepy also to see these human robot, like literally this woman, it was a robot, not a woman, but she looks like us. And you can just have a conversation with this robot, just like you'll have a conversation with the human, with the human, right? So we are kind of entering into this world where these human robots will be doing a lot of tasks, right? Even doing like daily chores. And then it comes to today when us as, we do any work, we have our identity linked to us. And then we get paid for the labor or the time and energy we kind of spend, right? But for these robots, they kind of running 24/7, and they do not have any identity. Or so on that angle, actually, when these robots are doing work, then basically the compensation, the energy cost to run those robots. This is where we can see stablecoin kind of play a big role. Maybe the payments would be via stablecoin, and this stablecoin will allow like instant payment, anywhere to like anytime, even between these machines. So that's like the one real example I see. Another real world use case is about actually trust in information. So today we kind of seeing that AI can easily clone voices, create fake videos, and make it look like a real person said something they didn't. And we kind of like seeing that a lot every day, right? There are like so many of those.
Hallucinations, yeah, galore.
Yeah, so that's where I believe like blockchain plays a powerful role because it can verify who the real source of that information. So in the future, we'll rely on blockchain to confirm what's real in the world, which is like basically full of AI generated content. So to me, AI and blockchain are like two sides of the same coin. AI will make decisions and blockchain will make sure these decisions are recorded and trusted. Together, they're shaping what I call the like next generation of digital finance, where money, data, trust, like all flow in one intelligent, like global system. So that's kind of like I see the future of it.
And do you relate it to that? Like, so we talk about like maybe Wikipedia entries, right? Like, and there might be false information there too. How do we take all this knowledge and information and convert it to the blockchain so
So
that AI does become better and more secure?
So the thing is, right now when we talk about AI, and we know that this is nothing but a hallucination, right? Right now, this is what we're using. We're training these LLM models, and the accuracy of these model is not like it's 70% or above or more or less. I don't know. There's even debate on that too,
Yeah,
right? Uh, so so that's right now it's just like in certain words, some people they say it's more like garbage in, garbage out. Uh,
yes,
right, you can't really trust like put the right information out there. So AI is actually basically kind of when it comes to like any information that's out there, AI is kind of capturing that, right? So blockchain role as a decentralized ledger,
hmm,
that's where you kind of storing it, right? So it's more like everything that you're building in the future, right? You kind of timestamp that information and you timestamp that on blockchain, and that's where you can see the authenticity. So it's more like everything what that we start building from here to basically kind of use blockchain and AI
together.
for that, yeah, versus right? Like, and of course, then I mean, look at us. We used to have all these, actual books, and now all the books are there on digital library, right?
Yeah.
Kind of digitize that. So it will be a same thing. And same thing, we have already NASDAQ market is so big. There are all the equities. When we tokenize it, you nothing front end, it's the same thing. You're still trading Apple stock, you're still trading Microsoft stock, but it's now a tokenized stock. So, at the back, it's more efficient.
So you're right. There's a lot of evolution that still needs to take place in other industries in order for these to be more robust. But it's interesting to evolve. And like you mentioned earlier, some of it's a little creepy. And as a friendly reminder to everybody in the audience, you are welcome to submit any questions you may have. But this talk about technology is actually a great segue to my next question because we see now there's this uh, different generational shift, right? We're seeing a wealth transfer of $85 trillion from older generations to a younger, more digital native generation and investors. So, what would you say is the impact of this shift on digital assets?
Um, So actually, the first thing so the first thing is actually this is one of that most important like shift we are going to see in our lifetime, right? Baby boomers, they are the richest generation in human history. Over the next 2 decades, we kind of like there's this estimate like 85 trillion or 130 trillion. I have seen different reports. So, that will be transferred from boomers to millennial and Gen Z. And actually it's ongoing. It's not like it's happening from today, but it's already in process. So that's the largest wealth transfer that have ever recorded. So what's really interesting is the difference in mindset between these generations. Boomers, they built their wealth through traditional assets, stocks, bonds, and real estate during one of the strongest bull market in history. And for millennial and Gen Z, on the other hand, grew up in a digital world. So they're more comfortable with mobile investing, blockchain, and tokenized assets. In fact, actually, there was a survey I came across, and that was showing that over like 50% of millennials already own crypto. And actually there are like more than 750 wallets or 750 million people in the world are using cryptocurrencies and invested into it. So but the crypto market is still a very, very small market. It's like 3.7 trillion, something like that. So that's compared to only like small fraction of boomers, and boomer money that's really like hundreds of trillions.
Sandeep,
Yeah.
may I interrupt for one sec? Just for everybody's benefit, it was just pointed out to me that if you have a question, you're going to have to send it through the Q&A. The chat function won't work. Sorry. Go ahead.
Okay. No, that's thanks for the reminder, BJ. Yeah. So let's kind of talk about like wealth, when we will see this wealth begins to, when this wealth is basically moving from baby boomers to millennials and Gen Z. So, the probability is very high. It won't all flow into the same old 60-40 portfolio. A meaningful portion will shift from digital assets and alternative products, especially as crypto matures as an asset class with regulations, ETF, digital asset treasury companies, and it has like institutional grade infrastructure. So we will kind of see that like a lot of that money is basically coming into alternative assets, including crypto. So in another day, study that came up, and even one of the top financial advisor at Wall Street, Rick Edelman, it was a very big kind of post from his end too, 60-40 portfolio, 60% equities and 40% bonds. No doubt it worked for a decade, but it's facing a challenge now, given like higher inflation. Right now, like hurdle rate itself is 11%, 8% debasement of currency, and 3% inflation. So that's like 11% is the hurdle rate. And on bonds, there's like a lower yield, and as dollar is weakening. So then that kind of mix just doesn't deliver the same risk adjusted returns it once used to be. So advisor will have to kind of rethink and basically think about like diversification. So if we kind of just like do a small allocation, basically, let's say 1% or 1 to 5% or 1 to 3%, right? That can even meaningfully improve long-term portfolio performance. And that was again, came from like Morgan Stanley. They are now even telling their, financial advisors, they should start, basically having access to cryptocurrencies. So it's basically just adds exposure to kind of high growth, non-correlated asset class that historically has outperformed during monetary debasement cycle. And that's how we see like Bitcoin has been the best performing asset in the last decade. So for, I think, RIAs and wealth manager, this is both a challenge and an opportunity. I take it like both ways. The next generation of clients expect to expect access to digital assets. They don't want to told, cryptocurrencies are risky. They want advisor more like, who can guide them responsibly through it. So I think we'll see the 60-40 model evolve into something more like maybe 50-30-20, and that's like that 10 or 20% into digital currencies, tokenization of assets, stuff like that. And advisors who understand that shift, they kind of like they'll educate their clients early, and they will be the ones who keep their client as their wealth transfer accelerates. And that is also like one of the trend that we kind of seeing that many RIA advisor, they kind of getting more and more educated on cryptocurrencies and digital assets, right? How do they kind of basically, as they have a fiduciary responsibility, so how do they give access to their client base in compliant way.
To be clear, is the only way an advisor would currently give a client exposure to crypto through an ETF right now in a compliant way? Or can you, as an advisor, advise your clients to have spot currencies as well?
So some are actually giving access to spot also. And this was, I think, last week, even JP Morgan, and that's different. JP Morgan, basically, they just said they will, have cryptocurrency like Bitcoin. I think it's only Bitcoin for now, but maybe in the future would be more to kind of, they will accept Bitcoin as a collateral. And then, all these other big institutions, Citi, Wells Fargo, like all these banks are also kind of coming on board, and they are saying, okay, how can they give access to crypto to their clients? So that's both on like on the retail side, and in the future we will see that. Right now, if you want to buy Bitcoin or Ethereum, like any cryptocurrency, you're basically either going to a centralized exchange or decentralized exchange or a wallet, right, where you buy with your fiat. But in the future, you may be able to easily do it via, with your bank also. But Fidelity actually, through your IRA account, you can now have access to Bitcoin ETF. And they are really ahead in digital assets. So that's where I think, what we were talking about earlier, like Clarity Act, all of that.
Yeah.
These regulations are in progress. Still, this industry is very new. So in coming months, we will be seeing more and more clarity, and then we'll see more access. But for now, even some of the RIAs, they are giving access to spot as well, not just only ETF. But many of them are heavily focused on ETF, just because it's more like a legacy product, right? Everyone is familiar with it.
Sandeep, we have a question from one of the participants,
Mhm.
actually a Seton Hall professor. Will intergenerational wealth transfer also be influenced by the current wealth consolidation? Will the consolidation to fewer owners of massive wealth change the type of crypto products that survive a natural product consolidation?
Actually, that's a very good question. Yes. So right now, if we look at the top like blue chip, that's Bitcoin, Ethereum, and Solana. Yes, there are like millions of cryptocurrencies out there. And this is, I think we can compare this with the .com in 2000, right? There were so many companies, and only like Amazon, Apple, like, like Google, the top ones survived, and they're doing extremely well. So in cryptocurrencies, a lot what depends on around actually on the network adoption. One trend that we are seeing right now, so Ethereum is actually, it's more like we kind of say that future of finance is getting built on Ethereum because it's been widely adopted and so many products are getting built on it. So that just like the probability of Ethereum kind of, doing well is very, very high. So there's a thing like, these layer ones. So layer ones are more like, you have this infrastructure on top of it, you can build those applications. So that's like a one, chunk. Then you have Bitcoin, which is more like digital capital, store of value, right? It falls under that category. Then there are some other platform which are more focused on NFTs or meme. So these are just different categories. But from financial perspective, it's more like, you look at like the top layer ones, and it comes back to like network adoption. When the it's more like, the company which has real utility, real value, the network adoption, they will do well. That is just like, that has a high probability of success. And so from there we can choose these winners. So even if we just compare this cycle with last two previous cycles in in digital assets, so we had a bull run in 2017, then we had another bull run in 2021. So 2017 was all about ICOs. So many people made a lot of money into ICO, but most of this ICO was just junk. Like more than 99% of those failed, right? Then 2021, we kind of saw another cycle. And today, 2025, most of these all are already losing more than 90%, 80 to 90% down. Only like Bitcoin, ETH, Sol is kind of like, okay, right? They are like, I mean, if kind of doing well. So I think in the future, we will kind of see it more like consolidated. Yeah. I hope I answered the question. Yeah.
Yeah.
Others?
We actually got another question as well.
Yeah.
Yeah,
Uh,
let's take that one. Yeah.
do
Because
you
we have
see,
only like 11 minutes, so we can, I think, take questions from the audience now. Yeah.
okay.
Yeah.
Yeah, and my last question was really just to sum up, but do you see product regulation to shift the crypto creators from the non-financial to the financial companies? It would be ironic if the disintermediators are themselves disintermediated.
Okay, I think on that, what I would like to say, I mean, so one, okay, I share one of the data point that I kind of familiar with. So as we know, Robinhood, they have been, really doing a lot of work around tokenization. And they have both the businesses. They have cryptocurrency business as well as they have traditional finance, right? And this was publicly, their CEO, I think it was on CNBC or Bloomberg, he was sharing this. Their cost to run both the businesses, on cryptocurrency side, it's 70% less because it's literally, when you're doing all these settlements, um, um, it's a software on the cryptocurrency side. So it's much more efficient, faster, and cheaper. They're literally saving 70%, on that side versus, like on the traditional side. So that's the value we are seeing. Another thing, as we kind of seeing that like with AI adoption, even now, like many of these companies are kind of seeing like they're laying off staff, right? So that's more like, again, we are automating these processes. So this is where we kind of see that in the futures, companies will go into like this digital mode where they're using tokenization, stablecoin, and you're improving your operational efficiencies. So you saving cost is much faster, all of that. So that's on that side. Now, about like intermediaries kind of losing that business. So I'm a very kind of more like I'm always like to see like glass is always half full. I always see that way. So to me, if we take like okay, Swift is actually one of their company. Stripe is one of that. Visa is one of that, right? One way of it's like blockchain is kind of threat to their model, but they are already adopting these technologies. Swift is working for many years, and they are really saying how does this blockchain technology complement their business model, and how can they improve their business model? Maybe these spreads won't be that high as what it is now. So it's kind of going back to the same thing, rotary phone call versus free, right? AT&T, was making a lot of money back in 90s when we had those phones, but they shifted their business model. So I think it would be same for these intermediaries also adopting these new technologies into their business model and kind of taking it from there. And Visa is doing the same thing for the back end for the settlement. They are using stablecoin. The Stripe is PayPal already announced, their stablecoin. I think it was 2 years ago, right? So there's like all of them are also kind of like coming on board. Yeah.
That makes sense. One more question. How resilient are stablecoins to economic downturns, and what mechanisms ensure their stability and security when traditional financial markets experience stress, especially in light of past failures such as Terra USD, Luna losing its peg? Traditional financial markets experience stress, especially, oh, sorry, I'm repeating that.
Okay. Actually, that's also another really good question. And when it comes to like, Terra, uh, it so these stablecoin, what I was talking about earlier, right? These stablecoin, they provide yield. You really have to see like where that yield is coming from. I remember that like, one of my friend, and he's actually a baby boomer, and he was a financial advisor, and he was kind of like back in 2021 when Terra was around, he was even trading it, and he was like, Sandeep, it's literally like 90% yield. I was like, wow, okay. I never traded it, but so thing was, it was like really very, very high yield that was, kind of provided to client. And then the question is, where does that yield coming from? How are they maintaining their collaterals? Like all these technical things matter. And one thing that I know, like when I was at Circle, when Circle decided to launch their USDC stable coin, one thing was very, very clear, like make sure we comply to the regulations. We do the right thing. And every 3 months, or it was, I think, monthly, that I don't really remember exactly, but it was more like, a third party audit firm basically auditing, a stablecoin company and making sure they are maintaining that collateral. And today, if you look at it, like, you can earn yield on USDC via Coinbase, but that yield is only 4.25%. Right?
Mm.
That's something you can also get in money market funds,
Yeah.
right? That's
Or a high yield savings account.
yeah. Yeah. So it's something that's sustainable. So if you are doing business, right, and your business is complying to all the regulations, and that's something that's sustainable, that is a good sign. But if it's like really that greed and something that's not sustainable, then the chances of failure are much higher. And that's what we kind of saw even with Terra Luna, right? That failed terribly. And I feel sorry for people who were invested in that. So it's again comes back to risk and reward, and right, like analyzing the right business, investing into the right strategy, right technique. I think all these things matter. Yeah.
Yeah. And so, this discussion brought to light, how much we've evolved over the last couple of years and institutionalized. Today, we have institutional custody, we have risk controls, we have structured products, but we also just saw in the past there have been risks. So, how do you see the next phase of institutional crypto adoption unfolding in terms of both risks and opportunities?
I think, one thing, this, what I was talking about earlier too, one thing that we are seeing especially in like, in last 2 years. So when it comes to like the heavy flow of money, that heavy flow we are seeing, one is in ETFs and then digital asset treasury companies. These companies are kind of have these structured products. And, so I think, so far it was more like building about like infrastructure and having legitimate institutional grade custody. So the first thing I want to answer, Ritu, because you brought up risks, so I'm going to go very, very high level on that. On the risk sides, we always have to make sure like custody security is bulletproof, right? And that's always going to be a very big concern for us. So today we're like BNY Mellon, Coinbase Prime Anchorage, like they're like the top custodians, right? And BitGo also, they are the one providing institutional custody. And I know like 11 ETFs when they were approved, 9 of them were literally using Coinbase Prime for their custody. And that's a concern too. Fidelity, they are doing their own custody. So it's again comes back to like these institutions who have good reputation, they are managing that custody risk well. And that's one of like always going to be like the big one for us. Personally, because I personally take custody very, very seriously. And I won't trust anyone for that. Then another thing is actually, on the opportunity side, we saw like ETFs and now having like regulatory clarity. That's kind of like build the foundation for us. Right. So, but I think the next phase will be defined like how institutions use digital asset, not just like how they access them. So, and that's where we kind of seeing like early signs of that with like treasury firms, like MicroStrategy, right? Or these public companies, they're holding Bitcoin directly on their balance sheets, and financial institution experimenting with tokenization, stable coins, and blockchain-based settlements, right? What we were talking about earlier. So these are actually all utility-driven use cases, not just speculative ones. And what also changing is like understanding that owning the underlying asset like Bitcoin, Ethereum, Solana carries unique advantage. It gives investor direct participation in the network growth and economies. And this is where our world is heading. It's like really becoming like part of that network and growth, right? It enables actually yield generation, staking, or collateralization, things that are wrapped or synthetic exposure can't fully replicate, right? So that's another thing that we can look into. And I think it also builds real interoperability with the broader on-chain financial system that's emerging. So I think, when we talk about like the next wave of institutional adoption is going to like move beyond access and exposure toward integration and utilization, where digital asset become like part of your balance sheet, risk model, and even payment and settlement workflows. And I see like it's 1 o'clock, so I'm gonna just stop here.
Thank you. Thank you so much for your time today. This was actually really informative
Thank
for
you.
me.
No, thank you. Thanks.